Good afternoon, and welcome to the third session of for the Forvis Mazars Pillar 2 technical series. Today we are going to cover we're going to cover today a little bit of the MNE groups in a more complex sense today. But without further ado, let me introduce everyone here. For those that have not met me up to this point, my name is Justin Metcalf. I'm a director with Forvis Mazars International Tax team in Charlotte, North Carolina. And joining me today, I will let Kate and Rami introduce themselves.
Hi, I'm Kate Morton, and I'm a senior manager with Forvis Mazars and International Tax.
And hello, I'm Rami Bouram. I'm tax senior manager as well, specialized in tax reporting and accounting and Pillar 2 as well. I'm based in Paris.
Thank you all. And just before we go into the material list, so today the idea here is to peel a layer more of the onion of what we discussed last week. So to kind of kick this off, I'm going to give us a little bit of a recap, because in order to understand some of the topic matter that we're going to discuss today, I think we need to have a little bit of a recap, so that others who were not on the prior ones and joining today will have a little bit of context to the material that we're going to be discussing. So, without further ado, in prior sessions, right? Last week we discussed, what puts you in Pillar 2, right? What makes you an in-scope taxpayer, and it's basically where you have an M&E group that has euro 750 million in at least 2 fiscal years in the 4-year period immediately preceding the current tested fiscal year. That by definition will put you in Pillar 2. Now, the question inevitably becomes, how do you characterize what is a multinational enterprise group, your M&E group? And that we discussed in the last session on how you quantify that. So we're going to expand a little bit, and after a couple quick discussion points on how Pillar 2 works, right, we're going to go right into definitional matters, and then go to some complex pieces of where the M&E group isn't necessarily so straightforward. So, Pillar 2, right, as we all know, it is a country-by-country minimum tax that was imposed, facilitated by the OECD, and has been adopted all over the EU and in most big developed nations today. We know the U.S. has not done that, but based on the way Pillar 2 is enforced, what really gives Pillar 2 teeth is its charging mechanism. So, Pillar 2 in a nutshell, right, enforces this complex top-up tax by jurisdiction, and what basically enforces the ability for countries to adopt and collect tax on Pillar 2 is its 3 charging mechanisms, which is, one, the qualified domestic minimum top-up tax, which is basically a local country minimum tax that follows the globe rules. The other 2 is basically an income inclusion rule, which is basically saying, if you start at the top of the house of your MNE group, and somebody gets to collect the relevant top-up tax on behalf of low tax constituent entities under it. Now, if, let's say, that the ultimate parent entity of the multinational enterprise group does not have a qualifying IIR, the rules say you basically keep going down chain until you find somebody that does. The UTPR is basically a catch-all, a complete backstop that basically says if a jurisdiction is low tax and it has not been topped up by a QDMTT or an IIR, you're stuck, and you have to the UTPR will basically ensure that that jurisdiction has been topped up. So by nature, hence by nature of the rules, it doesn't really matter whether the U.S. has adopted or not. In our case, right, for some multinational enterprise groups, because of this UTPR mechanism. So, I'll go through a quick example, right? This is a very simple one, and one that we used in prior sessions. But, if we think about this here, everyone in the group has a top-up tax. We got U.S., we got Netherlands, we got UK, we got Bahamas, and we got Canada. we know that Canada and Netherlands and UK will or have adopted a QDMTT, so they will be topped up by their own local government through their QDMTT that follows the globe rules. We do have a problem though, because here in our structure, Dutch Co BV, Netherlands owns the Bahamas. And for all sakes and purposes in our example, the Bahamas is a low tax constituent entity. Here is a prime example of how the IIR will come into play to ensure that the Bahamas has been topped up. That said, looking at our structure, right, everyone here has basically been topped up except the U.S., right, because the U.S. does not have a qualifying IIR today. Guilty is not that for all sakes and purposes. So the UTPR will basically come into effect, right, in 2025, and by happenstance, if Canada, UK, and Dutch Co BV have all follow through with what they said they're going to do, and fully implement the UTPR in 2025, the U.S. will be topped up by these three jurisdictions to ensure that everybody in the MNE group has been what we call Pillar 2 compliant. So that's a kind of a quick, fast overview of how these charging mechanisms work in the context of the globe rules. What we are going to so last week, right? We discussed this in the first session. Last week, we threw up what these calculation steps look like to get to your top-up tax, because the top-up tax is a relatively complicated calculation if you're actually having to do it, and not in the transitional safe harbor. So we started on the very first step, which was identifying our multinational enterprise group, and identifying the constituent entities and identifying their location, right? This is basically setting up your M&E group. And last week was a little more on the straightforward side, but there are complexities because of the definitions and the rules, which we will jump into here in a second. So let's start with some of these definitions. So, an M&E group, this is what we discussed last week, was that an M&E group is a group that includes at least one entity or a PE that is not located in the jurisdiction of the ultimate parent entity. So, we'll define ultimate parent entity here in a second. A group is basically a collection of entities that are related through common ownership or control, such that the liabilities, assets, income, expenses, cash flows of those entities are either included in consolidated financial statements, or excluded, or there is an entity in one jurisdiction that kind of forms a main entity group and a PE group, which we'll talk about in a nutshell. So, a group is basically what it sounds like for financial statement purposes, but for time's sake, so we can get right to the fun material we're going to talk about here in a second, I'm going to keep speeding through this recap here. So, we quantified what an M&E group is, right? In this M&E group, you have a UPE, you have entities. Some of them might be constituent entities, some might be excluded. By definition, and this is important because this will play into an example later, right? An entity is any legal person other than an individual or an arrangement that prepares separate financial accounts, such as a partnership or trust, right? We will piggyback on this trust concept because there's not a whole lot of commentary in the globe rules right now about what, giving deference to some of the more complex legal structures for trusts across the world. So we'll piggyback that there. And I'm really referring to the U.S. on that front. So, what is a constituent entity? What makes an entity a constituent entity? A constituent entity is an entity that is an entity it's an entity that is included in a group. It could be a PE of a main entity, right? Basically, if you don't have a true legal format for that, and it doesn't include any entity that is an excluded entity. And as we established last session, excluded entities are included in your consolidation test, but once you're in, our proverbial in the soup, right? Then the excluded entities don't come in, but they are included for testing purposes. The UPE is the ultimate parent entity. It's the most important distinction for classifying your M&E group because it's basically an entity that owns directly or indirectly a controlling interest. And we're going to piggyback on this controlling interest piece in any other entity and is not owned with again, controlling interest directly or indirectly by another entity. Main entity and PE groups, as we discussed last week, also fall into this, right? So you could have the main entity is usually the UPE of the PE group in the more, less formal structures that you have. But, we're going to piggyback on this controlling interest piece because this is what kind of sets up complexity when you're thinking about MNE groups. So that being said, PEs, PEs are included in there. I'm not going to elaborate on that because we discussed that in the last session, and for time's interest sake, joint ventures, are treated as, joint ventures, JV, joint ventures are defined as, basically anything that's above 50%, right, at least 50% of ownership in a constituent entity, where you share ownership with an unrelated party. So JVs, JV subsidiaries, and JV groups are basically treated as sub MNE groups to an MNE group for Pillar 2 purposes. So again, these are concepts that were discussed last session, but I do want to bring it back to everyone's attention because this will play into the examples to follow. Last session, we also talked about determining the location, right? And this is where you kind of quantify, you identify whether you have stateless entities in your structure or not, right? So there's specific rules for that. And why do we care about stateless entities? It's vital that we understand what a stateless entity is, because, just to give an example, I can have a German entity, right, that has its own top-up tax calculation, but then I can have a German stateless entity. Based on the way stateless entities are treated in the GLOBE rules, it requires two separate calculations. So it's possible where you have a German company in the German calculation for top-up taxes and a stateless German entity that has its own separate calculation. Because of that segregation, you could have top-up tax at the stateless entity level and no top-up tax in the true German jurisdictional calculation. So again, these nuances are very vital to the Pillar 2 calculation. So to kind of recap, permanent establishments, they basically, in the context of entities that are permanent establishments, there's a pecking order. You first look to the treaty jurisdiction to determine the location. If there's no treaty, you look to where there's taxable presence, very similar to our ECI and ATB rules in the U.S. And if there's not any mechanism in that entity's jurisdiction that has something like that, then you look at to what that jurisdiction would be under the OECD Model Tax Convention. If all three of those are silent, you have a stateless entity, right? And it's treated as it could be, like in my example, a German entity, but it's just not. It's not. It just has no state designation, and it's subject to being treated as its own separate state. That's in the context of permanent establishments. There's a context here about understanding where you have non-flow-through entities. So non-flow-through entities generally will not be stateless because they either have you first look to tax residency or where the entity has actually been organized and created. That part's relatively straightforward, and this is all under the Article 10 pieces of the model rules. Now, when you have flow-through entities, that's where you could have a little bit of a interesting dynamic where you have a stateless entity, and here's, you kind of see, a little bit of the trickiness when you're determining whether you have a stateless entity. If you have a flow-through entity, and we have a definition here. I won't go into that because that was discussed last, but, for everyone's, a recap and refreshment, we have it right here for you. A stateless entity is first looking to seeing whether the entity in question has ultimate parent entity status or intermediate parent entity status that basically says, hey, would this entity be able to collect under an IIR? If so, then that's the jurisdiction. Otherwise, it's a stateless entity. So that's kind of our quick recap, right, into what was discussed last week, and it's a little longer this time around because there was quite a bit that has been covered up to now. So without further ado, let me turn over to our first polling question. Has your company's M&E group and relevant constituent entities been determined? We'll give you all some time there to talk, and while you all are answering that, we are going to talk. I do want to piggyback to UPE and the idea of what is a controlling interest, because I think the main complexity in establishing your M&E group is, who is your ultimate parent entity, because that's what dictates the M&E group. And to determine your ultimate parent entity, you have to understand who has a controlling interest. And based on the way the definition of controlling interest is in the Globe model rules, that is where it gets a little bit tricky, where you have these structures that, really convolute and complicate, what the exercise is for purposes of Pillar 2. So, all right, so it looks like kind of a comfortable mix here. So hopefully this session will be helpful for you, for those that are not sure and answered no, in quantifying your M&E group. So without further ado, let me keep going. So I do want to piggyback to controlling interest real quick. So to be an ultimate parent entity, you need to not have somebody above you, right, that has a controlling interest, but you have to have a controlling interest over somebody below you, right, in the entity context. So what is a controlling interest? Because this is where which really sets up for this complex M&E group discussion. An ownership interest in an entity such that the interest holder, and this is what a controlling interest is required to consolidate the assets, liabilities, income, expenses, and cash flows of the entity on a line-by-line basis in accordance with an acceptable financial accounting standard. That part is relatively straightforward for most M&E groups. However, there is this or part, which we've often called the deemed to consolidate test, that says it would have been required to consolidate the assets, liabilities, income, expenses, or cash flow of the entity on a line-by-line basis if the interest holder had prepared the consolidated financial statements. This deemed to consolidate test is where you start to see a lot of complications into, where you have into who is the UPE and the multinational enterprise group. So to kind of piggyback this, we're going to talk about a little bit about these complexities that arise from the deemed consolidation test, and why this is important, and where you can have some tricky issues that we've seen, up to now in advising clients. So, Rami, I'm going to kick it off to you there, to bring us into the deemed consolidation test. So.
Thank you, Justin. Yes, I agree, and thank you for reminding all of those, definitions that are the basis of the complexities that we will be talking about. So clearly, the issues will start right now, because let's say once you have said that your ultimate parent entity is the one who is, let's say, consolidating every entity within its scope in its consolidated account, then you did not solve the issue under Pillar 2, because an entity could not be considered as your ultimate parent entity if basically it has on top of it another entity higher in the ownership chain that is required or would have been required, and this is the deemed consolidation test, to consolidate that entity on line by line basis. So here the controlling interest plays a significant role in determining who is the ultimate parent entity of the group. So it basically refers to the ownership interest in an entity that would require the interest holder to consolidate the assets, liabilities, and so on line by line. So it means that the entity is in charge of preparing the consolidated accounts of group could not be the ultimate parent entity if it has on top of it another entity that has a controlling interest over it. And again, this applies even if the entity that is on top does not prepare consol accounts. So to prevent against those situations, model rules introduce what they call the deemed consolidation test. So meaning basically that the ultimate parent entity does, if the ultimate parent entity does not prepare the financial statements, the consolidated financial statements will be based on what would have been prepared if the entity were required to do so. This preparation has to be in accordance with any authorized financial accounting standards. And in practice, groups are sometimes impacted by that, depending on the accounting standard that is applied. We'll see that afterwards, but the consolidation line by line could be different. So some structures could fall under Pillar 2 solely because they are using an accounting standard that has, for instance, a wide definition of control. And some other situations arise where a group discover that their ultimate parent entity is not the one that they expected, and they have to collect important data from their shareholders. I will hand over again to Justin on some US dedicated issues there.
Yep. Yeah. So, let's talk a little bit about this deemed consolidation test, right? If you're, what the rules are saying is if you would have to do this, right? So I want to use an example because I was picking on trusts, right? And that was deliberate earlier, right? So we know based on the model rules, right, an entity, is, you're a legal entity, how we always think about it, or it could be any legal arrangement such as a partnership or trust. What the OECD commentaries are not very clear on, at least to the best of my knowledge, and based on all the stuff that's been released, is, how are trusts treated for U.S. for Pillar 2 purposes? Because from anyone that is in the trust space, there is, the U.S. has some of the most complicated trust structures, and depending on where you are in which state, it could be, Florida, for example, right? You can have some pretty complex legal trusts set up, whether that it's not entirely clear that the Pillar 2 rules really were thought through in the context of trust. So why is it important? Just to articulate kind of an example, right? Let's say I got a U.S. trust that does not file consolidated financial statements today. Let's say this is some, just somebody's trust, right? And they own multiple different businesses that are very different from each other, right? Let's say they have a U.S. company with average revenue there of 800 million. Let's say it's in the car manufacturing space. I don't know why it would be a pass-through, but let's just hypothetically throw that out there to articulate the example. Let's say we got a Mexican DRE structure there where it's another group, and they're in a food business there. And let's say on the other end you got a UK entity, right, with euro of 1 billion that is a tech company. All this is if we're thinking about this deemed consolidation test, let's say US Co, Mexico DRE, and UK DRE all are, have their own consolidated financial statements, but let's say under an acceptable financial accounting standard, the U.S. trust would be deemed to consolidate, right? You kind of have a very interesting issue here, because under scenario 1, right, and this is usually where I think the more conservative answer is the U.S. trust is no doubt the UPE. It's an entity. It's any legal arrangement such as a trust, which it is, right? And under the controlling interest standard, it would, let's say under a financial accounting standard, it would be deemed to consolidate. If that were the answer, and this is where you get a little bit tricky, that means the U.S. trust is the UPE and everybody is the MNE group under it, right? This no doubt puts you most likely in Pillar 2. This company would totally be, this trust would totally be in scope for MNE for Pillar 2. Now, let's say, playing devil's advocate, the U.S. trust was not deemed to consolidate under any financial accounting standard, right? Well, then now you might have this situation where you have this U.S. trust, which, by definition under the Pillar 2 rules, under Article 1, and it's an entity, any separate legal arrangement, right, such as a trust or partnership. It's an entity, but let's say it wasn't deemed to consolidate. Now you have the situation where you have multiple MNE groups, and some, in our case here, U.S. Co and UK DRE are tech company and our our manufacturing branch company here are both in Pillar 2, but then our Mexican food company is not, right? These kinds of scenarios is what kind of complicates the M&E group structure, because understanding the deemed consolidation test with respect to these different aspects of what makes an entity and how would you be deemed to consolidate under financial accounting standards is relatively, in some cases, unclear when you're thinking about trusts, entity types like trusts, because different financial accounting standards have different requisites. So here is where you start to see some tricks in the trade. So without further ado, this is all meant to be discussionary. We're not concluding on any what is a scenario or not, but this is all about creating a thought process around, hey, giving deference to this controlling interest in the deemed to consolidate consolidating test is very crucial to getting you to understanding your M&E group in the cases where it's not so clear. So without further ado, let me kick it back to Rami here to take us to the finish line.
Yeah, Justin, I would, just explain again those situations that could raise some crazy differences within scopes for Pillar 2. So basically, let's imagine a world where you do apply IFRS 10, and it has within it an exception that is applicable only to investment entities where they are not basically required to consolidate by line their subsidiaries, but they need to fair value them. And based on that, you will see here in the example that Investco is, let's say, the investment entity under IFRS 10 standard that takes advantage from the IFRS 10 exception for investment entities. So it consolidates Service Co line by line, but it does not to Headquarter Co and its subsidiaries. So basically, what happens here is that Investco, if it reached the 750 million threshold on the revenue, it will apply Pillar 2 only at its level and the level of Service Co. It won't apply that at the level of Headquarter because under IFRS 10 it is not treated as a consolidated by line by simply as a fair value investment. So basically, Headquarter will be required to apply Pillar 2 at its own level without any mixing between those groups. But let's imagine another world where Headquarter Co would apply, let's say, IFRS standard. It would be in a position to consolidate its subsidiaries, Operating Co and Operating Co 1 and 2. I'm sorry, and based on that, Headquarter would be in a position to ask whether Investco, if it does not prepare any consolidated account, whether under a deemed consolidation test, it would have been required to do so. And if the answer is yes, then the group would be at the level of Investco. So then, basically, let's consider that Investco is in France, for instance. It has two applicable accounting standards. First one would be IFRS. So under IFRS 10, same scenario. It will be basically excluded from consolidating Headquarter Co line by line because it would qualify as an investment entity. But if it took the option to do that deemed consolidation test under French GAAP, then it would be different conclusion because under French GAAP there is no exception to consolidate Headquarter Co, whether it is only an investment or not. So there is no not to consolidate, I guess. So I'm sorry. So basically, it would have been in a position to consolidate Headquarter Co, and the group would therefore include Service Co, Headquarter Co, and its subsidiaries, and it would be much more larger. So very similar situations, very different outcomes depending on which accounting standard you are using. On the next slide, what you will see is let's say, different situations here where M&E groups could have different or various parent entities. So basically, it happens for groups that that prepare consolidated financial statements, presenting their financial, let's say, performance as a single economic unit. So model rules provide a definition for those multi-parented M&E group. It refers to those situations where the parent entities has entered into what we call an arrangement that is a stapled structure, or what we call a dual listed arrangement. So basically the stapled structure is an arrangement between two or more ultimate parent entities of a separate group, and it has very dedicated characteristics such as 50% of the ownership interest of the ultimate parent entity of the separate groups are combined and cannot be transferred or traded independently. And this combination can be due to each of the, let's say, form of the ownership, restrictions, or other legal conditions that limit, let's say, the transfer of the ownership. And basically, second condition is that they are in a position where they are required this time to consolidate financial statements and to present the assets and liabilities line by line. So basically, when those two conditions are met, first one is that there is a limitation to the transfer or trade in their shares, and second one that they are required by a legal requirement to consolidate their financial statements and to present it as a single economic unit. They would qualify as a stapled structure through Pillar 2 rules. The other situation is applicable to what we call the dual listed arrangement. That is basically an agreement between one or more ultimate parent entities, and that has a lot of characteristics. Main of them that they again are has their shareholders that are, let's say, engaged to have a fixed ratio when it comes to any dividends or payment or some stuff like that. So they are under that, they maintain separate legal entities. So they basically are managed as a single economic entity while they are having two or several legal separated entities, and so on. I won't go deep in that or deeper in that several conditions, but the main position here is that those multi-parent M&E group are often faced in the insurance sector, and basically whenever a multi-parent M&E group is qualifying for Pillar 2, entities and constituent entities of each group are treated as member of a single M&E group, and I mean, again, several consequences would apply. So basically, in practice, the ultimate parent entities of the separate groups forms a single multi-parent M&E group. It will be considered, let's say, as a single ultimate parent entity. They will apply IRR into their allocable share of any of the low tax constituent entities within the scope. So basically, they will pay for any top-up tax, and basically UTPR will also apply. And finally, what the very important thing here is that the ultimate parent entities will be as well required to submit a globe information return. However, they will be able to, by election, to appoint a single entity for filing purposes. So the globe information return here will include information about each of the groups that make up the multi-parent M&E group. You will see here that there's an example for that. So let's imagine again a world where you will have a M&E group 1 and 2 that are both of them constitute a multi-parent M&E group. Ultimate parent of each M&E group would, in the middle of them, and 50% of the ownership interest of an entity, which is operating entity number 1. Each M&E group were treated as a separate group under the rules, but the financial performance of the entity would have been reported under the equity method if they were separated. Here they are not. So operating entity 1 is consolidated by line. So what happens here is that operating entity 1 could have been a JV for both groups, joint ventures, what Justin mentioned earlier, but it is not, because it basically we're adding ownership interest of MNE1 and MNE2 in the operating entity 1 to make it as a regular constituent entity, and to make MNE1 and MNE2 paying their any allocable top-up tax within operating entity 1 at their level. Another example here, just to highlight this small difference, where basically if we were in again, if MNE1 and MNE2 were completely separated, then subco, which is in the middle, would apply Pillar 2 at its level. So it will basically be a POPI. Again, the POPI is an entity which is within your chain is, let's say, it means that POPI would have been in charge of paying the top-up tax related to its subsidiary. So basically, the ultimate parent entity is in charge of paying the top-up tax, but you might have some exceptions to that rule in when it comes to some POPIs that are partially held by the group. So what happens here is just to highlight that thanks to the multi-parent MNE group, subco wouldn't be a POPI, and any top-up tax will be allocated directly to MNE1 and MNE2. So this is important when it comes to charging provision and to understanding how this should be accounted for. Another pooling question here is to understand whether the deemed consolidation test implicate your company ability to ascertain its current MNE group structure. So please let us know. And the answer is could be C, I guess.
Yeah, it's I think Rami, that was great. I mean, I think what we're from an overall standpoint, this deemed consolidation test, right? It really does this isn't for every company structure, right? In some cases it's relatively straightforward, but this is where things get a little sticky and a little tricky when you're dealing with the Pillar 2 rules, because different countries have different different laws regarding different types of entity types, and the Pillar 2 rules really aim to this one unified approach, right? That's deliberate in the preamble to releasing this at the OECD. And it's, I think what we're seeing is this deemed consolidation test really complicates how this actually play. What is the how can we get to this unified approach when the Pillar 2 rules aren't necessarily diving into and considering every country's legal entity structure specifically with different kinds of things. So so looks like we got a lot of you not sure. So that's pretty fair.
Yeah, I agree, Justin. This in practice we had with our clients, we had several issues with that. The outcome is really unexpected. Shall we move forward on the next slide, just to give you an overview of a very dedicated regime that could apply to what we call the deductible dividend regime. So basically it applies to some structures that are cooperative structures, and this is the case for several jurisdictions in practice. So basically there's the 7.2 article of the model rules that tackle those situations where the ultimate parent entity is subject to a deductible dividend regime. So it means basically that it has the right there to deduct dividend paid to shareholders from its own taxable result. And in practice, those dividends paid to shareholders are often taxed at their level. So it could be regarded from an economical standpoint as a transparent entity that is not taxed at its level, but taxed at the level of its shareholder. Basically, what happens under Pillar 2 is that the globe income, which is the taxable basis under Pillar 2, could be as well reduced by those dividends distributed within 12 months after the year end after the year end. So basically, the reduction applies under several conditions. First one, dividend must be taxable for the recipient, and it must be taxed with a tax rate that is higher, or at least that meets the minimum rate, the 15% rate. And the OECD here expect that the combined amount of the adjusted corporate taxes, which is the taxes paid by the ultimate parent entity and the recipient, are at least equal to 15%. The recipient must be a natural person, very important. And if it is not a natural person, it must be a tax resident of the ultimate parent jurisdiction, and it must be a governmental entity, international organization, and etc. So basically, this is very dedicated to some structures. We had some issues just collecting the data related to that. Just to give you an overview again, from a practical standpoint, what happens in those situations is that the ultimate parent entity holds an, let's say, is that the reduction, applies to the corporate tax as well. So you are allowed to reduce your global income, but if part of it was taxable at your level, then you will need to reduce as well the corporate taxes. Any ultimate parent entity that holds an ownership interest in another constituent entity that is subject to the same deductible dividend regime will as well could apply that regime to its constituent entity, and basically, as long as they are located in the ultimate parent entity and subject to the deductible dividend regime, the recipient could as well take advantage from that because it pay taxes at its level. So one more thing here on the example, and I will hand over quickly to Kate. The last but not least, just a quick example here to highlight how this mechanism works. So it basically shows here that you will reduce your global income by 90 if it corresponds to a dividend that is qualifying for the deductible dividend regime. But at the same time, if there is any, let's say, remaining amount as a global income, then you will need, nevertheless, to apply global rules, and you will need to assess whether a total tax will be payable at your level. And for that, I will hand over to Kate, who will present what are the dedicated rules for non-material constituent entities.
Hello, I'm going to go ahead and go to our polling question due at the top of the hour here. Are you interested in a consultation with the Forvis Mazars team on how Pillar 2 may affect your company? A non-material constituent entity is a constituent entity that's excluded from the consolidated financial statements based solely on size or materiality. And the materiality is a question of the audited financial statements. It's not a judgment made by the ultimate parent entity or the person in charge of reporting the GLOBE calculations. In order to qualify as a non-material constituent entity, the ultimate parent entity financial statements must have been audited by an external auditor. They must have been consolidated in accordance with an acceptable financial accounting standard or authorized financial accounting standard. An MNE group that is composed exclusively of a main entity and its permanent establishments cannot, by definition, have non-material constituent entities. On the other hand, an MNE group that is comprised of multiple entities, where it has a main entity and permanent establishment subsidiaries, if the main entity is a non-material constituent entity, then the PEs under the main entity are also non-material constituent entities. And this is important because under the safe harbors, there's a simplified calculation. And the simplified calculation allows non-material constituent entities to reduce the compliance burden and data gathering for the inclusion in the GLOBE calculations. And the simplified calculation allows the GLOBE net income to be equal to the revenue as determined under the CBCR rules for the non-material constituent entity. And there are no deductions. So it is just simply a measure of revenue for that non-material constituent entity. In addition, the covered taxes are the covered taxes that are included on the CBCR, which means that they exclude any deferred tax expenses, adjustments for non-current items, and provisions for uncertain tax liabilities. So again, the importance of the non-material constituent entities is in applying the safe harbors. And we have an example here where you have two jurisdictions. Now, the application of the non-material constituent entity simplified calculations are determined not on a jurisdictional level basis. They're determined on an entity by entity level basis. And in these two examples, you have jurisdiction A that has two non-material constituent entities and no other entities. In jurisdiction B, you have 3 non-material constituent entities and 50 constituent entities that are consolidated on a line-by-line basis with the ultimate parent entity. Now, the UPE makes the choice to apply the simplified safe harbor to the entities in jurisdiction A, and so the global net income is equal to the revenue of those 2 entities, and the taxes are equal to those reported on the CBCR. And for the purposes of the ETR safe harbor, that is the effective tax rate safe harbor, where you calculate the effective tax rate in that jurisdiction. If it is greater than 50%, you meet the safe harbor. No further action is needed. And in this particular instance, using just the revenue and the covered taxes, you meet that safe harbor, which is good. In jurisdiction B, the taxpayer decides to apply the simplified method to only one of the non-material constituent entities. The other 2 are going to be blended with the 50 constituent entities that are consolidated on a line-by-line basis. So here you see the global net income as calculated in accordance with GLOBE rules for the 50 constituent entities plus the 2 non-material constituent entities, and for the remaining non-material constituent entity, you're just having the net global income equal to the revenue and covered taxes, as we've discussed. And again, they meet the safe harbor. This is an important consideration when you have entities that are well, it's difficult to get the data for them, and of course the auditor has deemed that they are not material. Moving on from this topic, we have a little bit of time left. I'm not sure if we should continue on to the flow-through entities that are ultimate parent entities. Any comments from Justin, Rami? Well, I'll go ahead and just, if anyone wants to stay, they can hear about ultimate parent entities that are flow-through entities. Now, under the GLOBE rules, when you have an ultimate parent entity that is a flow-through entity, you are allowed to reduce the GLOBE income of the flow-through entity by the amount that is reasonably expected to be taxed in the holder, that is reasonably expected to be taxed at the minimum rate in the hands of the holder, or the holder plus any taxes incurred by the flow-through entity level, those 2 combined equal or exceed 15%, or you can exclude from the global net income for the ultimate parent entity that is a flow-through entity. You can exclude from income all of the amounts where the owner is a natural person that is in the same jurisdiction as the ultimate parent entity, that's a flow-through, and all of those owners own less than 5% of the net income. And so in this example here, you have an ultimate parent entity that is a flow-through entity, and it's owned by 2 natural persons. And the question is, are those people, can you reduce the global income of ACO by the amount that is taxed in the hands of person 1 and person 2? And these 2 people each have a share of the 140,000 euros. So they're each tacked on 70,000. And the first one is taxed at a rate of 20%. So yes, excuse me, person 2 is taxed at a rate of 20%. So you can reduce the global income of ACO by person 2's 70% in a very straightforward manner. Now, person 1 also has income from another flow-through entity, a loss from another flow-through entity that offsets the income of ACO, such that that person 1's taxable income is lower and amounts to an effective tax rate for person 1 that is lower than 20%. However, because the full amount of the 70,000 euro that is attributed to person 1 was reasonably expected to be taxed at a rate of greater than 15%. The fact that it is offset by a loss from another pass-through entity is not relevant. Now, in this example here, you have the person 3 who has 50% of the income earned by SECO, which amounts to 100,000 euro. Entitled taxable to person 3, and this pass-through entity, SECO, pays tax in the local jurisdiction at a rate of 5%. Person 3 then is entitled to 95,000, which is the post-tax income, and person 3 pays tax at a rate of 11%. The combination of tax paid by SECO plus the amount paid by person 3 equals or exceeds the 15% minimum rate. That means you can reduce, for the purposes of the GloBE calculations, the income of SECO by the amount of income that was taxable to person 3. Now, this is the same example, but person 3 is allowed a foreign tax credit for the taxes that are paid by SECO. And this amounts to the amount of tax paid being less than the minimum rate. So SECO is not allowed to reduce the GloBE income by the net income taxable by person 3. And this is interesting from a tax planning perspective, because when you think about foreign tax credits and owners of pass-throughs, could there be some tax planning such that foreign income taxes incurred by person 3 on their income earned by the UPE that is a flow-through or a series of flow-throughs, could there be some tax planning done on those foreign tax credits such that the income of SECO is reduced by the amount that is attributed to the owners, and there would be no GloBE net income left? And the question then is, would the reporting and administrative burden of doing the calculations and the reporting come before or after the application of the reduction of the income based on the owner's taxes paid? Now, here you have you have a flow-through entity that has a permanent establishment in another jurisdiction. Person 1 and person 2 are both subject to their share of ACO's net income, and they incur taxes in jurisdiction B on the income that is attributed to that permanent establishment at a rate that is equal or greater to the minimum rate. And it's not the income of ACO, the UPE flow-through entity, that is reduced. It is the PE in jurisdictions B's GloBE income that is reduced. So it's interesting. And final polling question: does your company have any non-material constituent entities in its MNE group structure?
One thing on these polling questions. Thanks, Kate. I was having a little bit of a technical difficulty here when you said or chiming in. But one thing I wanted to also allude to here on these non-material constituent entities pieces people are talking through is the OECD has released guidance about a kind of a simplified safe harbor specifically for running the calculations in these pieces that we will discuss in a later part of the series down the line. But it is something that does have this kind of effect on that has interesting implications, Kate, as you allude to, specifically in the foreign tax credit side, where you could have varying structures. So one thing that in understanding the NMCEs safe harbor that I think that was released in the December of 2023 guidance is how does that cross net with when you're running the full globe calc if you do apply the simplified method that they talk about in the December 2023 guidance. All these are thoughts on that front. We'll tackle some of that in future sessions here. This is session 3 of session 10, so of 10 sessions. So it's quite a bit to cover, and we're not gonna, Rome wasn't conquered in a day, right? So please stay tuned for the next sessions as they unfold over the next coming weeks, where we hope to answer a lot of your questions on some of these rather complicated issues that some may be straightforward, some may not be. So there's quite a bit to unpack. So it seems like quite a bit have said not sure and no. Okay, well that's kind of fits in the sentiment of what we've seen in practice here. So yeah, that's a good consensus and a good temperature check there. So I think we're right at the end of the hour here, and I just want to say some closing comments here. We're very thankful for your time and tuning into these sessions here, and we do really value your time. And the idea of these webinars is really to help everyone that wants to attend kind of get a little more acclimated to the rules. So for next week, or I guess I think the next session's in about 2 weeks. Someone keep me honest there, but we're going to start unpacking the actual globe calculation, starting with Article 3 about the globe income and the adjustments to globe income. But we're hoping that these last 2 sessions have been relatively helpful in understanding the very first step of the globe calc. So on behalf of Forvis and Mazars, thank you for your time, and we look forward to talking to you and hopefully giving you new information in the very next session. Thank you.
Thank you.